a big welcome to this next panel, looking at the regulatory priorities for the year ahead. I'm Laurence Fletcher at the FT. I'm delighted to welcome an excellent panel for this discussion. We have on my left Laurent van Burik, who is Head of Unit for Legal, Internal and Enforcement for Investment Funds at the CSSF. He represents the CSSF at committees such as the ESMA Investment Management Standing Committee and the IOSCO Assessment Committee. Next, we have Furio Pietribiasi, who is CEO Mediolanum International Funds. He's responsible for the operations of Mediolanum in Ireland and Luxembourg. He's chairman of the board of the Irish Association of Investment Managers. And finally, we have Jérôme Reboul, who is Director of Regulation and International Affairs at the AMF. His directorate covers all areas of securities regulation, including market intermediaries, and infrastructures, asset management, transparency requirements, fintechs, and sustainable finance. I think I got that right. Again, we're going to have a discussion followed hopefully by a short Q&A at the end, so please do think of what you'd like to ask the panel. Also, when we finish, we have a short video by IFSAM as well, just lasting a couple of minutes, so it would be great just to stay and watch that before we break for lunch. I want to focus on the issue of liquidity management, and with the war in Ukraine having made the trading and valuation of some assets very difficult indeed, and markets also having been hit very hard this year, liquidity is again a major topic for the funds industry, particularly for funds offering daily or weekly liquidity. On Monday, ESMA put out a statement about liquidity management tools relating to Russian, Belarusian, and Ukrainian assets, offering guidance on the use of side pockets. Perhaps we could start with the regulators. Perhaps I could start with you, Laurent. How big an issue do you think liquidity management is for the funds industry at the moment? And what did you make of ESMA's statement?
Thank you, and good morning to all, and thank you for having me on the panel. I think we all know that liquidity management tools is not a new discussion. I think it started with the last financial crisis. Then you might remember in 2017, the European Systemic Risk Board invited the European Commission to work on liquidity management tool aspects in the level 1 provisions of our investment fund legislation. Then we had a short episode with the COVID crisis in March 2020, which had put under some stress certain money market funds, is it on the asset side, but also on the liability side. And then, of course, more recently, the Ukraine crisis. I think what we see is that there's some structural work being done in the context of the review of the AFMD on liquidity management tools. Is it in the alternative space and also in the UCITS space? And I think here the idea clearly is to basically set the basics of liquidity management tools in the level 1 legislation, have a definition of the different tools which are available to managers, and also discuss how to basically apply and deploy these liquidity management tools, including discussions as to how regulators need to be notified. Is it in advance? Is it an authorization? The work on that is progressing. It is very important, and I can confirm that the French presidency is pushing hard on those topics. So I think we can be hopeful that that work will progress quickly. The situation we now have, and that's the context of the ESMA public statement, which was published yesterday, is that with the Ukraine crisis, we have an immediate and exceptional event to address. And it is in this context that ESMA has come up with a public statement, which is basically saying that given the very exceptional circumstances, which might need some action now in order to protect all investors in the funds which are involved, and when I say all, it's existing investors as well as potential new investors going forward, we need to find a way to solve the situation that has resulted from the liquidity issue on certain instruments in those funds. And that's where the ESMA public statement basically explains what managers should look at when looking at potential solutions, and the statement is trying also to outline potential solutions. The CSSF has done the same at the end of March. We saw an urgent need to address this situation simply because we realized that the Ukraine crisis is going to go on for longer than we all hoped. And in this context, we wanted to basically explain to the asset management industry what tools can be put in place, again, in the very specific and exceptional situation of the Ukraine crisis. And that's what we have done. So I think we have two levels of discussions now. We have the structural discussion on liquidity management tools and a toolbox going forward. And then we have this very specific issue of the Ukraine crisis, where both the CSSF and also ESMA basically say this is for an exceptional circumstances and it needs to be done on a case-by-case basis, taking into account all the different features that apply to a given fund. So we are not in a situation where, for example, one can now conclude that side pockets are possible in the UCITS space, generally speaking. We are saying under certain circumstances, this solution can be looked at. And about side pockets in the UCITS world going forward, we need to look at the work which is ongoing at the level 1. That's I think, where we are.
Fantastic. Thank you. Thank you. Jérôme, could you add your perspective on this?
Yes, sure. Thank you for having me. I think there are two issues in your questions. There is a very specific question, which is the one of the use of side pockets in the current context due to the Ukrainian war. And I would very much concur with what Laurent said. I think we are in very exceptional circumstances, and I strongly support the initiative taken by ESMA to invite all supervisors in Europe to use this tool in order to provide partial liquidity to investors. I would say the slight regret or concern that we could have is that there are various technical ways to enforce side pockets. ESMA is very precise on one specific technique, which happens to be the one that we are using in France, but there are other techniques, including ones that are actually smoother, and we would be interested in implementing those alternative techniques for which ESMA is not very precise. To be fair, there are a number of technical questions and technical difficulties that are involved in those alternative techniques, so I perfectly understand that it was not very simple for ESMA. But I think we need as much legal clarity as we can on this specific topic, and I hope in the course of the French presidency we will be able, or in the coming presidency, in the context of the discussion that we have on AIFMD and UCITS, we will be able to provide the clarity that we need. The second question that is in your question, I think, is a much broader one. It's related to the context of the discussions that we have on the availability of liquidity management tools. There are very wide discussions at the international level on this issue, in particular around open-ended funds, with a number of academics and central bankers, if I may say, who claim that there are specific concerns with liquidity mechanisms involved in the asset management industry that provide excessive volatility or excessive cyclicality, and call for the implementation of tools that would lean against those cyclical effects. I think in this context, our feeling at the IMF is first, I think we need a very wide availability of liquidity management tools to address specific concerns that we might have regarding the liquidity of funds. In this respect, our preferred option would be to have a very wide availability of liquidity pricing mechanisms. We feel the most problematic aspect that we can find in some instances is that there may be funds for which it is not possible to price the actual cost of liquidity, and in terms of market stress, it's a very big issue. And this is a very wide aspect of the asset management industry. On the other hand, I think we are very uncomfortable with the idea that we would need a broader macro-prudential across-the-board capacity of public authorities to act in a counter-cyclical way. We are not convinced that there is a strong argument for an excess volatility mechanisms that would be widespread in the asset management industry. And we feel that having a macro-prudential tool has a very significant drawback, which is that it is a tool that by definition is not in the hands of the asset managers. And the basic of the asset management industry is that asset managers should have the prime responsibility to act in the best interest of investors. So this is where we are.
Great, thank you, thank you. Furio, could I get your views as a fund manager, actually, on how much of a concern this is and what you thought of the statement?
Liquidity is it's a challenge, has always been a challenge, it will always be a challenge, particularly in extreme scenarios. It's difficult, and I understand the position of the regulators, to try to help and to give confidence and comfort to the investors. I will focus more on the usage, so the more open-ended retail type of solution, rather than focusing on the alternative one, which are much more dedicated to professional investors. It's true that we have also, well-aware investors, but, let's stick with the usage. Why I think it's very difficult, because we have seen events like war. It's not something that you can find a methodology to fix a problem like sanction for Russia, and how you deal with that. Of course, there is the side pocket, there are different types of solutions. We have seen many years ago where there are countries that decided to stop the exit of capitals and they lock them in. And therefore, you cannot liquidate and you cannot get the money back. Obviously, we have seen it in the emerging market. But we went through the financial crisis, and we have instruments that were the most liquid. I remember very well because I lived that. The instruments that were more liquid than the U.S. Treasuries that suddenly dried up in a very fast. So I think it's difficult to try to find a solution and resolve a problem of liquidity, and it will always be there, the exceptional one. Nevertheless, I think it's important to avoid situations where they are much more normal in the normal cycle of the market, where sometimes there is we interpret the rules in a way that gives opportunity for our investor to benefit of investment opportunities, but then sometimes they might be turning back, kicking back. We have seen, particularly in the investment in the liquids, in the usage. So I think like everything, we need to have an happy balance. But it's obvious that I'm welcoming regulations that are helping to manage in a normal cycle scenarios. I would be wary to have rules that are trying to fix and deal with the exceptions, because they could become complicated, could limit as well the investment opportunities. And we know the exceptions, yes, they do happen, but luckily we have a period of times where generally the market conditions, they're not always positive, but even in the negative scenarios, they tend to be normal negative scenarios where the asset managers are fully equipped to manage. Yep. And it's obvious that there's another element that when I'm talking about the normal condition, of course, there are strategies that they tend to be very complicated, and we have seen even recently using strategies that with some volatility, which was some shock in the market, but which could have been considered a normal shock within a market cycle, that they found themselves into trouble with their derivative position. Collateralization in the end ended up to be liquidated. So, I think that there is more work to be done, and but on the other side, I think that we'll never get rid of the problem.
Sure, thank you. And looking specifically at side pockets as a possible solution, perhaps I can go back to you, Furio. How do you feel about those, and what potentially could they sort of look like?
It's actually a good idea. I think it's to a certain extent, particularly for funds where you have a particularly relevant portion of assets invested in securities assets that are going into trouble. I wouldn't put, use a side pocket even when there are small investments, because obviously the materiality is very important in this case. Because I think it's fair, even though you do a lot of work to try to price these assets, but I think it's fair that when there is materiality there for new investors, that they're coming into the funds, they have the ability to invest in something that really reflects what they're investing in. It would be potentially a great surprise that they bought something very cheaply, but it could be potentially a very bad surprise as well, because they might have spent more money on what they thought investing in something that didn't really add that value. So I think that in the retail space, as well as in institutional, if you want to keep the product alive, does make sense. But obviously, materiality is absolutely critical.
Sure, sure. And can I go to the regulators now? What might that sort of side pocket sort of look like in practice? Esma's spelt it out a little bit, but yeah, could you spell out a bit more?
I think we have different solutions. We have solutions which are, I think, easy to implement and more easier to implement than others. We have the model which has been outlined in the ESMA statement. We have models where you can create side pockets, we hope, through share classes, which are less burdensome from an operational perspective. If you decide to segregate the liquid assets into a new fund or new sub-fund, the question is, what portion are you going to segregate? Is it the illiquid one, which is more a residual part of the assets of the fund, or are you going to segregate out the liquid part, which is more complicated from an operational perspective, because generally that's where you have the most of the assets. You have questions, of course, under the UCITS regime as to the compatibility of side pockets with the current regime. On that, we consider that basically the only element you have today in level 1 of the UCITS directive, which doesn't specifically recognize side pockets, is Article 1.5, which is basically saying that if you transform a UCITS, you cannot transform it into something else than a UCITS fund. That is where we are, but the discussions in the context of AFMD and UCITS, which I mentioned earlier, are going to address this issue because they're going to specifically recognize those of the liquidity management tools which are permissible. So I think today we're in a situation where they are not specifically recognized, but they are not specifically prohibited neither. So the revision will probably provide even more legal certainty on that specific aspect. So there are different models. They all have advantages, disadvantages. It really depends on the very specific situation of the given fund, which has a problem to solve as to what tool he's going to select in terms of side pocketing.
Right, fantastic. But you think in terms of new legislation, that won't be required then because of what ESMA's doing, or what we have to see?
No, I think we are clearly engaged in the discussions of the level 1 in defining a toolkit. And we need to see if, at the end of the day, side pockets will be retained as a solution for UCITS. But I think we all welcome the work on level 1 to clarify that. I also think that the Ukraine crisis, you mentioned that, somehow has shown how good of a solution a side pocket can be in a given circumstances, because it allows existing investors to exit the fund. It allows to open up the fund again for new investors without getting a free ride on assets which might be valued at zero or at a very low level at one point in time. I've seen the consultation of the UK FCA on that topic. They also outline basically the advantages of this tool. So, I mean, I think it is necessary to look into that tool in the discussions of the AFMD and UCITS review to see how suitable it can be for UCITS. But on our side, we think that under given circumstances, it can be a good tool, always with the caveat that moral hazard needs to be dealt with. But that's something we can look at, so that shouldn't be a problem.
Sure, thank you, thank you. Jérôme, anything else you can add on that? And also sort of what amount of sort of legal certainty can you give to managers as well?
You know, I think Laurent has clearly made a very good summary of the questions that are currently under discussion in legal terms. I would say in terms of outcome for investors, we basically have a choice between settings where we are providing very strong degree of legal certainty over the segregation of assets, but that are quite long to implement, which clearly has a cost to investors, because the benefit of side pockets is to offer that partial liquidity, and usually you want to have access to liquidity quite fast. And the alternative is smoother, faster, and easier, but it provides a little bit less legal certainty. To be frank, the feeling that we have is that the second alternative is very attractive. But then I think there's still a legal issue to be settled, which is whether it's fully compatible, or do we need do we need some adjustments to the legal framework that we have today? So that's it. I would very much concur with the idea that it has to be a very exceptional tool. Clearly, it's not something that has to be used in the normal course of event. And I think this addresses the concern that some member states can have over the moral hazard risk, because in fact it should remain the asset manager's responsibility to pick assets that under normal circumstances remain liquid. It's only under very, very specific circumstances that we would be ready to accept that side pockets are needed. But of course, we can hope that a crisis like the one we have currently does not occur every week.
Sure. Thank you. And looking at the use of them as well, to what extent do you think, perhaps I can address this to Furio, will investors be able to understand this issue? There's already maybe been some sort of...
liquidity or side pocket?
Oh, the use of side pockets, actually.
But, well, actually, I think it's very easy for investors to understand. You know, we need to go back that it's not going to be the bin where goes the bad calls or calls that I don't want to liquidate because today are suffering in terms of pricing, but I'm convinced it's going to be greater pricing, because that's not the use that should be. But if the use is, you know, events like Russia, for example, or similar events which are market-driven or linked to a company that, you know, the number of portfolios that could be getting into trouble for liquidity issues and so on, different reasons, then you can explain to the clients as you can invest, you know, new clients, and you're not going to impact it with this. So if you want to redeem, going back to the point we were before, you are not going to lose something, because obviously people will, oh, that's okay, but what about this? You know, we see products, funds that are maturity date. You know, think about maturity date, UCITS funds that they have today security in Russia, Ukraine, Belarus, and the fund is maturing, so you need to return the money. Yes, of course, you can go to all the investors saying extend it, but technically it's maturing. And the investors, they are going to receive some money and say, yes, but this company, they didn't really get bankrupt. This company, they might have ability to recover in the next future. So having a side pocket gives them 100% comfort that they are not leaving anything behind. So I think it's absolutely fair. Obviously, it's important, the cost and the size, because I was talking about materiality, because one of the points I didn't want to go through before, but you know, now and this answer is important, is the cost, because you need to explain to them how much it's going to cost to maintain and administer this side pocket, because at the end of the day, if I leave there the side pocket and in 1, 2, or 3 years, the cost charged to the side pocket are going to eat up what is in there, then it could become a bigger problem. So, and that's where I think that the clients may have an element to say. And then the other element is the commission and the fees that you charge on the side pocket. Is the investment manager, should the investment manager still charge a management fee? Should this or should not charge a management fee? Yeah, that's an element. A lot of the industry has changed a lot over the years. And I think that today we have seen a lot of managers that even when they get the fund, they decided to waive or reduce the management fees, or when they were side pockets, people have, in the alternative space, decided to waive their fees. You know, even recently in France, we have seen with side pocket, with asset managers, that they found themselves with some assets that were, not liquid, and they took certain decisions. So I think it would be working very well.
Great, thank you. And just actually on that issue of fees, can I ask both the regulators, is that something that it might require a regulator intervening in this in terms of setting a rule about charging fees on side pockets?
Well, I think it's a case-by-case scrutiny that is called for, to be frank. Of course, I think in each file where we need to examine whether there needs to be a side pocket, of course, we need to pay special attention to the risk that investors might not be served in their best interest. This is our duty to do so. But I don't know if we need a specific general rule around charging fees on side pockets. I don't think so. It's a very infrequent case. To give you an idea, I was referring to the fact that in France we have a habit of using side pockets, but actually we have currently one fund for which we are considering using side pockets, and I think in the last 20 years it has occurred 5 times. So that's really a very infrequent event.
Sure, thank you. And back to you, Laurent. You mentioned potential moral hazard. That's something that ESMA highlighted as a possible concern. How much of a sort of a worry might that be?
I don't think it's a concern right now, because the managers who have funds which are now in the situation where they might need to look at side pocketing didn't know they were going to be in that situation 10 weeks ago. So I think in this discussion we are assessing the possibility to use side pockets on a case-by-case basis, as I said, in the best interest of all the investors and under scrutiny of the regulators. I think the question of moral hazard will more come into play once we look at somehow generalizing the tool of side pockets in the usage context. If this is what we are going to retain as a solution under the review of AFMD and usage, there we will need to address that. It should not be the way out for somebody who somehow, between quotation marks, didn't manage the fund as he was supposed to be. So it's a tool that is designed to solve a complicated situation, probably in very exceptional circumstances. And that's why I think the moral hazard issue will come into play when we discuss the tool in the context of the AFMD review, basically.
Sure, thank you. Jérôme, anything you'd like to add, particularly on that issue? I mean, ESMA also highlighted some other potential problems as well. For instance, you put assets in there that won't actually become liquid again, and also operational problems as well for some platforms. To what extent are these things that can be ironed out, do you think?
No, I think the concerns raised by ESMA are perfectly legitimate. Of course, we need to monitor them, but in any case, you need to look at side pockets in contrast to what the alternative is. In a context where you have a significant share of the asset side of the fund where there is actually no available valuation, the choice for the asset manager is to either do a side pocket or to suspend. So I think if you are able to have a side pocket, it's better for the investor in principle.
Sure. And in terms of disclosing the use of side pockets to investors, how might that be disclosed in marketing material, for instance? What might you want to see as a regulator there?
Going forward, I think the idea is that the funds will disclose the liquidity management tools that they might use under given circumstances. So I think the idea of the review in the context of the AFMD review is to disclose upfront the toolbox to the investors, so that they will know from at the time they basically invest into the fund what tools might be used during the life of the fund. So that's I think a good solution. So yeah.
Fantastic, thank you. One other thing that ESMA suggested as well is that maybe some fund managers were a bit too quick to write down Russian assets to zero as well. Is that something that you have looked at all? Does that feature in your...
I think it's too early to look into that. It always depends on the situation of the fund. There are different types of securities. You have securities which were suspended from trading because the Moscow Stock Exchange was closed. In addition to that, we have securities which are subject to sanctions or where the issuer is subject to sanctions. So it's very difficult to say if certain managers too quickly undervalued the securities. Perhaps we will be able to assess that once the situation is solved, but for the time being, it's definitely too early to conclude on that, basically. So, yeah.
Sure.
I think managers apply a fair valuation and are prudent in the valuation. So the situation is very exceptional and serious. So there are probably good explanations as to why some decided to value at zero, basically. So.
Sure. Thank you. And Furio, can I ask you as well, is this an issue that you came across in any of your portfolios, and what sort of approach did you take?
We, as a multi-manager, it's obvious that we have seen some exposure in Russia, but was it too fast? Actually, I think that everybody has been to write down pricing, I'm saying. I think that everybody has been working very well, because at the end of the day, is against the interest of the asset manager to devaluate too fast prices, because has an impact on their P&L. So if they don't really believe that that is absolutely necessary, they don't have the elements to justify this absolutely necessary, they wouldn't be doing it. So from my perspective, I can't speak for the market, but for the managers that we have been dealing with and we have been engaging with, I think that they had done a lot of work to get there, and it was fair. So, and we had all the elements for our oversight and what they were doing and were their calls.
Fantastic, thank you. And we're going to have to wrap up in 2 seconds. Any final points in terms of going forward 5 years? What might the regulatory situation be in terms of liquidity management? How might this now look in 5 years' time?
I hope we will have this toolbox in level 1. Is it for use? It's an AIS. And nothing indicates that we will not have that. So that's positive. And then we will need to work on basically how to concretely implement those tools once we have the toolbox in level 1. And that's probably, I guess, a mandate the level 1 will give to ESMA. So yeah, and that will be a discussion as technical discussions with ESMA between the industry and national competent authorities, ESMA. So very positive on that. So
fantastic, thank you.
I think what we can hope for the next few years is to provide a greater availability of liquidity management tools across the board in all the asset management industry. We hope we won't have to use them. And I would add, I think one major issue that we have in Europe is that we need to make progress in being able to use them in a coordinated way. Because in fact, to investors, and you have raised a number of questions around that, it's a very important topic because they need to know what is the exact profile of their investment. So the fact that we have divergent practices in Europe today, I think is a problem in the longer term. So I hope we will be able to foster supervisory convergence around the use of liquidity management tools by asset managers.
Fantastic.
And I insist in saying that the liquidity is an intrinsic part of an asset manager job. Liquidity premium is something that where asset manager makes money for the clients. So we will always have to be the ability to play that call, and I'm sure the regulators will do the right thing for the extremes.
Fantastic, thank you. It just remains for me to say thank you so much to our panel, to Laurent, to Furio, and to Jérôme. Thank you so much for your time and for an interesting discussion. Thank you.
Was there a video that was going to play? Yep.
Maybe move aside because I'm in the middle of the screen. So.